Hi everybody, this is Lara at Elliott Wave Gold with your end of the week video analysis for the trading week ending Friday 17th of May. Gold is range bound again with resistance about 1310, support about 1265. I am expecting a downward breakout is more likely than upward. If we see a downward breakout, and it doesn't need support from volume for confidence, if we see it, the short to mid-term target is at 1219, it may not be low enough, but if we see an upward breakout above 1310, which does require support from volume and a close above resistance, then the target is about 1346. Elliott wave analysis first, classic analysis last. I'm also going to swap over to motive wave and show you some historic examples of how gold works with trend lines in this video. I am really struggling. I'm really trying hard to try and make the gold analysis as clear and simple as I can, but the problem is that I expect gold is still possibly within a correction, and so the problem then becomes Elliott wave corrective structures are quite complicated. The bigger picture for gold is I am expecting it is still within a big three-step back movement from its all-time high back in 2011. After that all-time high, gold was in a bear market, and then it's been essentially moving sideways in an ever-decreasing range for years now. I expect this may be an Elliott wave triangle. And so the big three-step back from that all-time high in 2011 subdivides A, B, C. Now the question I have this week, is B over, or is it going to move a little bit higher? And on balance, my judgment says that it's probably most likely over at this stage. We've had some whipsaws this week that have been particularly challenging to analyse. This is my preferred wave count because it follows a most common Elliott wave corrective pattern. There are only two Elliott wave motive structures. Motive structures move price in the bigger trend direction, and they subdivide as fives. The corrective structures move price against the larger trend, and they subdivide as threes, or in the case of triangle, fives, and they're labelled with letters. So you have fives in the trend direction and threes against the trend direction. This wave count sees a B wave, possibly complete here, is a regular contracting triangle, and in a B wave position that's a fairly common Elliott wave corrective structure, and this has unfolded in the most common way. 4 of the 5 subwaves of an Elliott wave triangle must subdivide as single zigzags. Only one of the 5 subwaves can be a multiple, usually a double zigzag, and that the subwave most commonly to subdivide like that is wave C. The E wave of a contracting triangle most often falls short of the AC trend line by a little bit, and that's what happened here. So this looks like a perfect end here to cycle wave B. If B is over, then a 5-wave structure downward for C should have begun. I will label it as a 5-wave motive structure at primary degree, subdividing 1, 2, 3, 4, 5 to meet all Elliott wave rules. Elliott wave is fractal. Let's look now at the potential structure of wave 1 at 2 must subdivide as a 5-wave motive structure. That's either an impulse or, for a first wave, a leading diagonal. An impulse is much more common, and so that is what I will expect, unless until overlapping tells me to consider a diagonal. And so for a first wave at intermediate degree, I'm looking at primary degree, I'm looking at intermediate 1, 2, 3, 4, 5. Intermediate waves 1 and 2 may be complete, and now intermediate wave 3 may have begun here. It may only subdivide as a 5-wave impulse, and so again moving down a degree, Elliott wave is fractal, looking at minor waves 1, 2, 3, 4, 5. Let's take a look now at the daily chart level where the high for B is this point here. Let's have a closer look now at how intermediate wave 3 may be unfolding. Beginning here, it may have minor wave 1 as a 5-wave structure, 5 steps in the direction of the trend. Minor wave 2 is a 3-wave structure, 3 steps against the trend. This wave count now expects a 5-wave impulse for minor 3, which will be labelled at minute degree 1, 2, 3, 4, 5 to meet all Elliott wave rules. When that's done, minor wave 4, possibly a shallow, brief correction, which must remain below first wave price territory. Now here's how you can apply Elliott wave rules to your trading. If this is the correct wave count, then any short entry to trade this third wave down that's entered before it moves beyond the end of 1 may be held throughout the end of the third wave and possibly even throughout the relatively brief, relatively shallow fourth wave correction, because the fourth wave may not overlap back into first wave price territory. So price should remain below this point throughout that upcoming correction. A target is calculated for minor wave 3 to reach 1.618, the length of minor 1, about 1219. Applying Elliott wave rules to the impulse of minor wave 3, no second wave correction within this impulse may move beyond its start. Now the problem here with this whipsaw that we had this week, which was really difficult to analyse and ridiculously difficult to trade, is how it's behaved with this base channel. Draw a base channel from the start of a first wave to the end of a second wave, and then place a parallel copy on the end of the first wave. Gold usually behaves well with base channels, but not always, and I'm going to show you a beautiful example of where it just didn't work. Sometimes it doesn't work because early on, particularly early on in its third waves, the second wave corrections do not find resistance as expected here in a bear market at the upper edge of the base channel. The base channel can be well breached, and yet price can turn on down and continue in the larger direction. Let's have a look. I've got an example on motive wave here. This is back. This is the beginning of a third wave at primary degree. This is the 24th of October 2008, this day down here. Here's a base channel. This is a bull market, so it works in the opposite way. I've drawn this base channel from the start of the first wave to the end of the second wave, and then I've placed a parallel copy on the end of the first wave. In a bull market, the lower edge of the base channel usually, not always, but usually provides support for lower degree second wave corrections. But here, the base channel was well breached. Price is now well below it. As the third wave builds up with overlapping first and second waves, passes through its middle and then explodes at its end. So we have 1, 2, and the third wave ending up here. It did not work well at all with the base channel. But we can tell in hindsight that this is most likely the correct Elliott wave count. It agrees with MACD, and this is all historic, so you can meet all Elliott wave rules with this Elliott wave count and see your first, second, and third wave here. So there's an illustration of how gold does not always behave well with base channels. We may be getting some of that here. So this breach of the base channel is a warning that the wave count may not be right, but it is not definitive. At the hourly chart level, for this main, now again, preferred wave count, which sees minor 2 over here, minor 3 must subdivide as an impulse. Within it, minute wave 1 may be an almost complete impulse, subdividing at minuet degree 1, 2, 3, now to see 4 and then 5. 4 may not overlap into wave 1 price territory, so long as it remains below or at or below this price point. It's an overlap which violates the rule. It can touch the end of wave 1. I have seen that happen before, not very commonly for gold, but other markets I've seen it happen. It's any movement into wave 1 price territory by any amount at any time frame which violates the Elliott wave rule. This wave count expects a little bit of sideways movement to be followed by a short little fifth wave possibly. As soon as we see a new low below the end of 3, then minuet wave 5 would have avoided a truncation. It could be over at any stage. Look out for a larger bounce for minute 2. As soon as we have a new low below this point, this invalidation point no longer applies because minuet 4 can be labelled as complete. And then this is the invalidation point that applies. This is risk. Minute 2 may not move beyond the start of minute 1. There is strong reasonable resistance still up in this zone. So there may be a bounce coming next week. At the weekly chart level, this is the next idea, considering the idea that cycle wave B may not be complete. Now my first wave count labelled cycle wave B over here. Now I'm considering the idea that cycle wave B is still a regular contracting triangle, but that the final wave of primary wave E is incomplete as a zigzag subdividing 5, 3, 5. This wave count needs now to see intermediate C move above the end of intermediate A to avoid a truncation, but primary wave E may not move beyond the end of primary wave C at this price point. That rule is absolutely black and white. This wave count will not allow for a new high by any amount at any time frame. Even a fraction of a cent on a tick chart fully invalidates this wave count. This wave count may expect primary E to still end with a little undershoot of the AC trend line, and then we may see the beginning of cycle wave C. So this wave count allows for a few weeks of continued upward movement. At the daily chart level, here's the end of intermediate A and B and the start of intermediate C. Now I've drawn an acceleration channel around the possible start of intermediate C from 1 to this high here with a copy on 2. This channel is fully breached to the downside. Now these channels, again, here's the problem with gold, particularly in the early stages of its movements. The channels just don't always work. They're a bit of a rough guideline, and so both wave counts have problems with a channel no matter how we're drawing it. Here the invalidation point's not too far away. Minute 2 may not move beyond the start of 1. Intermediate C must subdivide as a 5 wave structure at minor degree. So far there may be 1 and 2 complete. Now looking for 3 and then 4 and 5. 3 may only subdivide as a 5 wave impulse, subdividing at minute degree 1, 2, 3, 4, 5. 2 may not move beyond the start of 1. A new low by any amount at any time frame invalidates this wave count because no part of 2 at all, not even a fraction of a cent on a tick chart, may move beyond the start of 1. That would violate the Elliott wave rule. So we have some nice clear price points to tell us which of these 2 wave counts at the daily and weekly chart level we should be working with next week. My classic technical analysis favours the first wave count, and as I've shown you, going back to motive wave and historic examples, gold does not always work well with its trend channels, particularly in the early stage of a movement. Now I'm going to go back to the weekly chart and show you why I say the early stage of a new movement. Here's a nice impulse on the weekly chart, A, B, C, and here within C, 1, 2, 3, 4, 5. You'll notice that 4 is brief and shallow compared to 2, which is deeper and more time consuming. Here's another example. 2 is deep and time consuming. 4 is brief and shallow. I see this over and over again for gold. Typical commodity-like behaviour. It tends to be slower and have deeper corrections starting an impulse. It accelerates through the middle of the third wave and explodes sometimes at the end of a third wave. That makes channels rather difficult to work with at the beginning of a movement, as it sometimes forms a curved movement. It looks like a 3-wave structure at higher time frames. That may be what is happening here. This is the next idea. This is quite a different idea at the weekly chart level. The bigger picture still sees that huge 3-step back, A, B, and C yet to begin, And now we're looking at a different structure for B. My first 2 weekly charts look at B as a regular contracting triangle, but here I'm looking at B as a double zigzag. My experience over the years with Elliott wave triangle has taught me to always be suspicious and always have an alternate wave count. Too many times over the years I have labelled an Elliott wave triangle complete or almost complete, only for it to turn out to be invalid, and the structure turns out to be something else. The something else is usually some kind of combination or multiple. And within combinations and multiples, it's double zigzags, which are the most common of those by quite a wide margin. So let's consider a double zigzag for cycle wave B. The first zigzag in the double may be complete here. It's labelled primary wave W. The double may be joined by an incomplete corrective structure in the opposite direction to be labelled primary X, and when that's complete, this wave count would expect another zigzag to be labelled primary wave Y, the purpose of which is to deepen the correction, so it should be expected to move well above the end of primary wave W to achieve its purpose. But here's a problem with this wave count. The structure of primary X is problematic. Within multiples, X waves are almost always zigzags. They can be any corrective structure, but they are uncommonly triangles. This does not follow a common Elliott wave pattern. Within the triangle of X, the most common subwave to subdivide as a multiple is usually C, but that's not what's happened here. It's B, which is subdivided as the multiple. Again, not the most common pattern, and so in just an Elliott wave terms of probability, I have to judge this wave count to have a lower probability than my first 2 weekly charts. And finally, the last idea. What if the big 3-step pattern was over down here? What if gold is in a new bull market? How does that fit? Can we make an Elliott wave count fit? And does it make sense? Well, we can make it fit. You can make all sorts of things fit, but it doesn't make sense. The problem is here. If gold is in a new bull market, then the first movement of a new trend has to step forward in a 5-wave structure. But the problem here is the gross disproportion between primary waves 4 and 2. Gold, I've shown you before over and over again, typical of commodities, exhibits deep, time-consuming second waves, accelerates through the middle of the third wave, explodes at the end, brief, shallow fourth wave, strong fifth wave to finish, forcing the second wave to be more time-consuming, the fourth wave to be brief and shallow, giving an impulse for gold, a 3-wave look at higher time frames. It almost never does it the other way round. This is a really strong indication that this wave count is just wrong. The 4th wave correction is much more time consuming and covers a much greater distance in terms of price. It is huge compared to the 2nd wave correction. This disproportion in the way that's not normal for gold reduces the probability of this wave count. But it is technically possible. I can make it work, and I want to consider what if gold's in a bull market. Now here we get into a technical analysis problem. If gold is in a bull market, and there's a first 5-step up here, 3-step back complete here, and now the start of a 3rd wave. 3rd waves should be unmistakable. They should have increasing ATR and they should have support from volume. This one has declining ATR at its beginning and it doesn't have good support from volume. This does not make sense. This does not look like the start of a 3rd wave. This wave count has to be judged to have a low probability. But it's technically possible. If we see a new high reasonably above 1365.68, this would remain at that stage my only Elliott wave count for gold at the weekly chart time frame, and at that point I will start to take it very seriously. But for now, based on the data in hand at this time, I must judge it to have the lowest probability of all of my wave counts for gold. Okay, let's take a look and see how the week closed. we had this strong whipsaw back up to test resistance, which is quite weakened but still evident, about 1300 to 1310. This has been a strong area previously of resistance and support, and further off to the left of the chart as well. So this looks like maybe another test of resistance. This week has a long upper wick that's quite bearish. Price is closed very close to the low for the week also. That's quite bearish. The balance of volume is down. Volume is actively pushing price lower. At the close of this week, this is quite bearish. This supports the idea that we may be about to get more downward movement next week. Gold is range bound with resistance about 1310, support down here about 1265. This looks like we're going to get a downward breakout, and if we do, we'll be expecting lower lows. From the slow back here, gold has a series of higher highs and higher lows. That's the basic definition of an upward trend. After the shooting star candlestick and the bearish engulfing candlestick pattern, we then have a series of lower lows and 3 lower highs. It looks like there is a high in place. Let us assume that there is a downward trend until proven otherwise. On balance volume this week is at support. This may assist to halt the fall in price. If support is broken, that would be a fairly weak bearish signal. The support line is not long held, only has 2 prior tests, although it is pretty much horizontal. ADX is declining. It is telling us that the previous upward trend may now be over. The DX trend lines have not switched over though. ADX is a lagging indicator. It's based on a 14-week average. ATR continues to decline. There is still weakness within the trend that is still giving me some concern for my main weekly Elliott wave count and making me consider that that double zigzag count may actually be correct. I will continue to publish that on a daily and weekly basis for you. We do need to take that actually quite seriously at this time. RSI is neutral. There's plenty of room for price to rise or fall. Stochastics is oversold. But if we do have a new downward trend, ADX hasn't caught up yet, but we do have so far a little series of lower highs and lower lows, then stochastics can remain extreme for quite a few weeks when this market trends. MACD is bearish. What about the shorter term picture? This was a strong upward day, prompting me to consider the possibility of price going on to new highs, but that was quickly whipsawed, and now we've had 2 strong downward days. Friday closing very close to lows. Overall, a little bit of support from volume, pushing price lower here. Tells me to expect probably now more downward movement next week. This could have been a small blow off top. We have had some difficult whipsaws this week for gold. That's why I've got those 2 Elliott wave counts on the daily chart for you to use those confidence and invalidation points to work with those. On balance volume is nearing support. This may assist to halt the fall in price. If it breaks below the support line, that would be a weak bearish signal. This line has been weakened by the break above resistance there. Next support line now won't be too far away. This doesn't have good technical significance though. It's only got the minimum 2 anchor points and it's got a reasonable slope. But we could be seeing some weak bearish signals coming from on balance volume. RSI is neutral. There is plenty of room for price to rise or fall. It's not giving us some signals either way. ADX is still declining. The negative DX line is above the positive. If ADX starts to rise, it would be telling us there's a downward trend again in place. And ATR is overall flat. For my main Elliott wave count, that really does need to start to show some increase. Stochastics back in neutral territory, and MACD bullish but not full bore bullish. That's all from me with your gold analysis this week. I hope all our members are having a most awesome weekend.